All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest with us, Scott Choppin. And Scott has spent his life working in the commercial real estate space since 1983. And he mostly focuses on multifamily development projects. He's, eventually served as the director of land acquisitions for a multi-billion dollar um, portfolio company. Scott also founded the real estate development company Urban Pacific over 20 years ago and has developed over 3,400 units with almost $1 billion worth of exits. So today, what we're going to talk about a few different topics, but the realities of being a real estate developer in multifamily and how to become one. Value add projects versus new construction. Which one should, multifamily investors or sponsors pursue? And we're going to talk about how to survive and thrive during uncertain times like COVID, like how we are now, hopefully coming out of it. Definitely coming out of it in the next couple of months or a few
Looking
months.
forward to coming out of it. How about that?
Can't wait. So Scott, did I do you justice with that bio, or is there?
Yeah,
no,
that's great. I appreciate it, Anthony. That's all good facts. Lots of years as you start to mention the years starting to stack up. So,
great.
But it's good. It's good.
Great. So talk to us about first how you got into real estate development. Why multifamily versus self-storage, industrial? Why apartments? Where are the apartments? Where do you focus? Just kind of tell us about your story.
Absolutely. Yeah. And if I miss any of those, remind me. But
Sure.
Great question. So, and great to be here, Anthony, by the way. It's really appreciate the invite.
Pleasure.
So I've basically, grew up around real estate development. So my dad, Kerry, and my uncle, Mike, were both real estate developers in their own right. And part of the reason that I focus on multifamily is that they were multifamily developers. My uncle Mike did a lot of commercial office, but did a lot of apartments also. And so, I had the background when I was growing up. Now, I didn't necessarily know as a kid or a teenager necessarily I saw what they did. I saw the buildings. I even, I used to go pick up trash in the mornings before high school for my dad on his project site. So I sort of, as a kid would observe, real estate projects, but it didn't have any meaning for me until I was about 18. And I read a book, a series of books, sort of in the domain of, how to invest in real estate, really old school era books, like from the 50s and 60s, really, like if you read them today, they'd be really super over simplistic. But what those books taught me was what it was to be a deal maker, right? In other words, how to find an asset that was undervalued or mismanaged. And these were residential multifamily. So again, the same theme. And that really opened my eyes up. I go, oh, okay, this is what my dad and my uncle Mike are doing. They're taking land and building new buildings and then renting the apartments and really, producing value increase in that process. It's still a similar, buy low and sell high, except in this instance, you're buying a raw piece of ground, you're designing and building a new building, you're renting out brand new units, and then you produce value through that. That change process that you've gone through. In fact, my joke in the company is real estate development is the ultimate form of value add, right? If you're going to compare the two. And for that, for many people that are in the investment space and multifamily investment space, I think they look at development as an opportunity, but it's also a place that maybe a lot of unknowns. Even, people describe to me, I was on, been on several podcasts where afterwards, the people go, yeah, I've been looking at development, but man, it scares me. It was on Michael Blanc's podcast, and he was nice enough to share with me. He goes, I've looked at development, man, but that's a scary domain. So I get that. And, that's part of what we can talk about today. But so, from that point on of really sort of having the epiphany of what deal making was and sort of pairing that up with my observations of as a kid of what my family did, that set me on my path. So, went to college, got a degree in finance, and then, was intentionally went to work for other professional development companies to learn the trade, if you will, to learn how to be a real estate developer. And although, again, I'd been around it, there's the day-to-day things that you have to know very competently that I knew that I would learn best really working in a professional real estate development environment. And, spent several years doing that. And then in 2000, left to form Urban Pacific, as you mentioned previously.
Excellent, excellent. So when you joined Urban Pacific, so where were you focusing on, you know, growing your development portfolio? Did you start out buying existing apartments and then implementing value add, or
Yeah,
heading
to be
straight
real
into
honest with you,
development?
Anthony, we've always been a real estate I've always from day one, when I finally chose what my career path was going to be, it was always going to be new construction apartment assets. I mean, we've done as a company other like new construction condo, we've done new construction affordable housing, in the government subsidized domain, but really, always, in fact, several years ago, I've always for many years, I considered investment and development to be sort of the same thing, but they're different, although they have many overlaps is now the way I think of it. We still underwrite apartments the same way, whether we're buying new or building new or buying existing. At the back end, we still value them the same, right? How much rent do we produce? What's the NOI? What's the value and the cap rate? But in the middle is this space where you got to deliver and execute on new construction, new design, empty land, political process. And that's really the key difference. So I've always worked in the new construction apartment development domain. All the companies that I worked for professionally after college were all apartment development companies. And then when I launched Urban Pacific in 2000, it was our intention as a company was to develop new assets in the urban environment, right? I think urban infill is one of the terminologies we use, meaning we're in the city fabric and we're finding underutilized or vacant sites to develop new housing, but it's still inside of an existing city. So that's versus going out on the edge of a community and building on brand new green fields, people call it, where, it's never been built before. Maybe it was farmland, or here in SoCal, maybe, used to be orange groves, although there's not a lot of those left. Or, more peripheral, further out, right, is the way to think of greenfields. And we want to be as close to the central business district as possible, although we don't generally build right in downtown, although we have done that. But, think we're 2 or 3 neighborhoods from the central business district, or the other place that we describe as urbanized suburbs. Right. So they're not your, commuter an hour back and forth to your job and you live in the house and there's, nothing around it. These are older suburban communities where the city's enveloped them and grown even past them. So places like Orange County, California, a lot of places in Los Angeles County as well.
Got it. That's awesome. So when you look at developing a project, are you developing it? Are you managing it at all, or are you straight up selling it after you're done?
Yeah. So let's see. Traditionally, from the start of the company through 2016, we basically merchant built everything in the business, meaning build it, rent it, sell it. Right. You lease it up, you stabilize it, and you immediately sell it, monetize it, and move on to the next project. In 2016, 2017 is when we started to develop a specific product type we call urban townhouse, or UTH for short. And that's a 3-story townhouse rental unit. So it's brand new construction, but it's a townhouse model. And our specific offer is a 5-bedroom, 4-bath townhouse model, intentionally designed and built to rent, and rent to middle income working families or roommates, both of which are like living an economic sharing lifestyle, right? So roommates, live in a unit to share incomes and expenses to make it more affordable. Families, multi-generational families, do the same thing. And so the first several projects in that UTH program, we merchant built also. And we did those, what I call demonstration phase, because we wanted to test the model. Because guess what? Very few people, almost nobody's doing 5-bedroom, 4-bath townhouse rental product in California, certainly not at scale. So we went through this demonstration phase, proved several variables to be, in fact, correct. The experiment was successful. And then you go, okay, now we start to, scale the model in a production phase. And so I give you all that background because basically about 3.5, 4 years ago is when we started the program. And then about 2 years ago is when we really started to get into the story about long-term hold of developed assets. So in other words, we develop it and normally sell it, but now we go, oh, we want to hold this because we see a changing picture in the future. And that's really a couple of things. One is fundamentally, we're such firm believers in the undersupply story in California and many urban markets for middle income families. Like we think this is just a lot of runway ahead of us for successful development and long-term value production in the portfolio of these assets. But also about 2 years ago is when we started to just in our own economic research, we track several economic variables, on a monthly basis. We're tracking several, economic prognosticators, people who, look at the future for economics. And we started to really see a picture where we were due a recession, right? Like in 2018, 2019, people started to talk about, hey, we're starting to get close to the longest economic expansion in US history, which in 2019 and early 2020 was 10 years. Other variables that we're tracking, so things like the yield curve went inverted in 2019. And so we just started to get this feeling after going through 2008 and seeing how that started, and then the middle term, and then the end of that, like we watched that, cycle sort of play out. We anticipated that residential wouldn't be so affected in whatever the next recession was, which now ends up being 2020. But we still wanted to be prepared. So we went long-term hold on everything. We're not going to sell any assets unless it's very opportunistic and there's just, great offer, or there's some logic to it. And so then that puts us into a story of we do property manage some properties when they're small and mid-sized development projects. And then, but anything big will third party manage. And that's traditionally our model, like on other assets that we've developed that were larger, like say institutional grade, probably in California, that'd be 75 units and above. We'll look for third party managers, but then our internal property management team would oversee those other property managers in a asset management role. And then Eric Christopher, who's our head of property management, also runs a team that does our own internal management activities on, assets that are really close into headquarters and or, maybe small and mid-size where the economics of hiring a third party wouldn't work.
Got it. Okay, so you're basically buying, raw vacant land, and then you're going through the, political approval process to get, entitlements. And then now it seems like what you're doing, you're building, and then are you refinancing once
Mm-hmm.
you're done? Yeah, once you're done, and then yeah, because you have to, right? You can't
Yeah, we need to
maintain
take
that.
the construction. So it like to differentiate it. So obviously in a value add, you'd get your loan, you'd get your equity, you'd close the deal, you'd upgrade, you'd raise rents, and then, well, maybe in that case, you might have a bridge loan. And then you may take out a permanent loan later. But for us, we always do a construction loan taken out by a perm loan. Right. So always have two pieces of debt. I mean, if we developed an asset with a construction loan and then sold it direct to the marketplace, then we wouldn't do the perm loan. There'd be no need. But when we get to the end of the construction cycle and we've leased the units up and we're stabilized post construction completion, we have to have some liquidity event to take out the construction loan because guess what? Those construction lenders, they're not long-term holders. Their rates and fees aren't structured for long-term hold. So now almost exclusively we'll go out. So, example, presently we're working with CBRE Capital Markets. They're, giving us a soft quote on a Freddie Mac structure to take out the construction lender on an apartment asset in Orange County. We'll lease the asset up. We're actually about 85% leased up. As soon as we get above 90, then that starts a clock. We'll go 60 days of seasoning, and then the lender can close after they've seen the stabilized, fully occupied, at least the levels that we agree on. And then the perm loan would then fund, take out the construction lender. In that case, that asset in particular will roll into a new equity fund that we're putting together. And then that will be that equity fund, amongst other structures, will be our long-term hold vehicle.
I was just going to ask you, what do you do with what we like to call for our audience, it's called a cash out refinance liquidity
Yeah.
event. So
Yeah.
sometimes you're returning, well, in construction, you're returning all the equity most likely.
Yeah,
plus
that's right.
then some. So you have to
Yeah,
find,
it
and is
depends.
that
We have some investors that will want to stay in, and in fact, our recommendations to investors who can get comfortable with the development cycle is if you can come in at the beginning and you want to hold the asset long term, then you get not only the long term appreciation as you normally would in a value add, but then you also get the appreciation that you generate in the development cycle, meaning political, lease up, construction lease up. And so, you can get, the narrative that we have about it, Anthony, is if you're an early investor in development deal and you stay long term, it's like buying the asset at a discount. You have to take, of course, more risk, and we can, every investor will assess risk differently, but it may not be much different if you're buying a distressed asset in a particular market that may be having job growth issues or job losses. You can get it at a great discount, and that is a mitigator against risk of taking on that like difficult asset. Real estate development has, of course, a different risk profile, and that's why a lot of multifamily investors that are used to value add, it's not comfortable space for them. And we get that. We understand. That's usually first question we ask is, okay, and Mr. or Mrs. Investor, what kind of experience do you have in the development domain? And if they have none, then we know how to build a certain background and have a certain, be in a narrative about what that looks like, versus if somebody's like, nope, I've invested in thousands of assets or thousands of units of new construction. They get the construction cycle, they get the, lease up cycle. That's all, then we won't necessarily spend time trying to build background there.
got it? Excellent. So are you typically cashing out your investors, or are you, like you said, giving them the option to still, whatever what we like to call a promote structure, whatever that
Yeah.
is moving forward, they're still a part of that? Because I know some developers do it differently. They literally,
Mm-hmm.
maybe pay them 10, 12% over a couple of years, and then they're out of the deal once you have the cash out, or you do the cash out and plus then your promote starts kicking in. So they're
Yeah.
still technically in the deal. Is that?
I would say the quick answer is most of our construction period investors, that's how I describe it internally, are on a short-term window, like you're describing. Hey, I'll be in with you for 2 or 3 years while the project goes through its development cycle. I want to get, this return, this hurdle rate, buy me out at the end. Like, as an example, we have a project in Montebello. We have a equity fund management company based in Israel called SDB, and they raise money in Israel from high net worth, families, family offices, individuals, and bring it over to the U.S. to invest in ours and other projects. And the appetite locally in Israel is for short-term investments, not long-term hold, although we're talking to SDB about, converting some of these to long-term holds. But, hey, we're going to be in it for 3 years, take us out. We want to get our IRR. In fact, we have a negotiated in that particular deal. We have a negotiated, hurdle rate. Hey, if you just want to buy us out and you want to keep it, then you got to pay us, X IRR, full stop. And they just get cashed out. Otherwise, if we sell it, then there's waterfalls, right? And the normal IR structures. But they were actually forward looking. We, at the point of time we did Montebello and started, we weren't necessarily in the story of long-term hold on that, but that ends up going to be the last asset that was developed before we are now doing everything long-term hold. So now all new projects post Montebello are all going to be long-term hold structures. So 80+% of the people will take out at the perm loan funding with a new source of equity. In fact, that's why we're working on this equity fund, which is slated right now to be about a $30 million equity fund, probably 120 million, 100 to 120 million total assets value. And that'll be the source of takeout equity, if you will, perm period equity to then. And then, that fund, once it reaches into new assets, then they'll have the advantage of getting in early, like I described before.
Excellent. Okay. So that makes a lot of sense from an equity standpoint. Now let's just talk about the cycle of where we're in. Obviously, you're in California, which everybody knows it's a very high cost of living there.
Yeah.
I'm in New Jersey, New York area. It's very similar.
Yeah. We're neck and neck.
Almost neck and neck. Yeah. I don't know whose is worse right now, but California. So when you're building new construction, you mentioned you do workforce housing. So I'm assuming there's some light tech, maybe some, historical tax credit deals you've done. are you generally free market new construction, or what would you prefer?
Yeah.
Because as you go to the free market and you don't have the ability to get those credits or tax abatements,
Hmm.
whatever it may be, from the government, um, your basis is, I'm assuming in California, going to be pretty up there. So your
Yeah,
rent's got to keep up with that. So I
exactly.
guess my question is, how, and obviously, yeah, that's why I asked you if you still own, if
Hmm.
you have holdings, ownership holdings of your properties. I'm just curious how collections have been with the new
Yeah.
construction over the past, you know, 8 months since we've been in
Yep.
this health crisis. Um, if they've kind of held up, and do you think that they'll continue to hold up as we get
Hmm.
into 2021? I'm just love to get your opinion on that
Yeah.
because
So several answers. Great question. So let me just share with you, our UTH model is actually is a new innovation. And what I mean by that is we pair private capital with a workforce housing model, but it's not your government sanctioned, government subsidized LIHTC deal. Like you mentioned, low income housing tax credits and other government subsidies. We actually, so if you got market rate over here, think luxury, new construction, high rise, mid rise, downtown, sexy, super high rents. On this end, you got government subsidized, what I call true affordable housing. We're actually going to sit in the middle of those on purpose. Like that's the whole purpose of the UTH model. And what we're basically doing is we're bringing a private equity structure like you would have in any market rate deal, where we have to produce, yields to investors that attracts capital like anybody else, but we're pairing it with this workforce housing model. And really the secret for why this works is because we're building these 5-bedroom, 4-bath townhouse units. So it's a simple mode of construction, right? No podiums, no high rise, nothing complicated. In fact, we're always looking to simplify our designs, make it more production oriented. But what ends up happening is the whole dollar rents for our 5-bedroom units, maybe right now averaging about $3,500 a month, which ends up being about $2 a square foot roughly. And what we're end up at is we sort of an equilibrium point. If you were on a graph, it'd be the crossover point between maximum rent generation and lowest cost, right? So in other words, that 3-story model is the right point for the lowest cost maximum rent generation. And then we have this 5-bedroom, 4-bath, we're generating very high whole dollar rents. Now we need to buy land well. We need to have really simple financial structures. We avoid entitlements really at all possible points. In other words, we want to buy zone sites. So we shrink the time schedule. We simplify the building model, the construction methodologies. We're buying land in really what I describe for the UTH models is an A product in a B and C neighborhood, right? So it's where working class families already live. We're just now giving them a brand new unit with 5 bedrooms, 4 bathrooms, 2-car garage, right? Outdoor front, entrances, no common hallways and foyers, which is, an issue in these, in the pandemic. And so where we end up right now today, Anthony, is our model is actually accelerating. So we're actually, as people think recession, most investors go, oh, well, that means I should be looking for distressed assets. And they're right, except that there will be models of, business models and business plans that accelerate in times of harm, right? There's a term called anti-fragile. It's a book, name of a book. And that's basically those things that are benefited from harm or accelerate during difficult periods. So that's exactly what UTH is. And the reason for that is because we're 5-bedroom, 4-bath, we're the place where people move to when they're recombining in a family group or roommates, right? So if 2 people were living in a studio, one person in a studio, another person in a studio, and their employment situations are becoming untenable or changing, or they're reduced hours, they're a single earner household in a single unit, right? So as soon as their income's disrupted, they're going to move out of that unit. And they're going to move. Are they going to move home with their parents, with their families, or are they going to find roommates? And so our 5-bedroom, 4-bath unit is a place that people go when they leave other apartment projects, either new construction or existing, because they can share the cost of the housing amongst more people. In fact, the terminology I have for that is economic sharing, meaning multiple earners sharing incomes and expenses across either a family group or roommates, right? So I'll give you an example. In our Fullerton project in Orange County, we've actually had great success in the last few weeks renting to professional roommates who are released from their work locations because their companies converted to virtual work, virtual working rules, or the standard. And all of a sudden they go, oh, now I don't have to live where I worked. If I lived in Alameda County in the Bay Area, I don't have to live there anymore. Like, I can go wherever I want. And so what we're finding is people are starting to gravitate to live with their friends. You go, oh, Joe and Jack and Jane, they were friends. They all lived in different cities, but now they're all released from their work obligations geographically. And so they're starting to look for places, just, hey, let's go live in Orange County for a while and go roommate up, and we can share the cost. So we're actually getting roommate groups who it's 3 roommates who are renting the entire unit, and then the extra 2 bedrooms to become work from home space, like a home office, right? And so we're in this interesting time period where we're actually accelerating from that. Now, of course, the family groups are our primary focus, right? Because our model is a moderate income model. That's our primary, focus, because we want to serve these families that are otherwise under pressure. And when they start to live multi-generationally and multi-earner household, again, economic sharing. So think mom and dad, maybe an adult kid or 2 moves home, maybe in-laws, maybe grandparents. They share, again, the incomes and expenses, and that basically makes them to be more defensive in a downturn. In other words, they can sustain, they share these incomes, they can sort of batten down the hatches. And in fact, in 2007 through 2009, the last recession, Pew Research did a study where they had tracked families that started to move in together, right? Recombinations, the word I use for it. And there was 49 million households that moved in multi-generationally in that 2-year time period. And we're already seeing the front edge of that now, as people go, oh, I'm not going to pay for that unit by myself. I'm going to move out of there. I'm going to go move in with X, Y, or Z, be that family or roommates. And so again, another like area of acceleration. And then when you lay on top of all that, Anthony, just to finish the question, we're in California. I think out of the top 25 most expensive markets in the United States, 18 of them are in California. So I think, at least in that stat, we sort of win the bad, award of high cost market. And so that forces people into that economic sharing model, even during good markets, right? That then becomes the affordable housing model. And that's why I call it naturally occurring, because these people move in together. And although it's not a rent restricted unit by the government, it does serve the purpose of being more affordable to those people because they're living a multi-generational lifestyle. In fact, I'll share this just to finish. Out of our 5-bedroom, 4-bath townhouses, every unit has a ground floor bedroom bathroom, and that basically can accommodate in-laws or grandparents who may have mobility issues. They can live with the family, right? We accommodate that, from the get-go.
And that makes a lot of sense. And you answered all my questions. So
Okay, good.
That's perfect.
Yeah.
So as we kind of look forward with some final thoughts, what would you say to, maybe it's an existing multifamily operator that let's say they get development deals all the time and they wish they knew how to do development. What's the best way for them to level up? I don't even know if it's leveling up, but almost exploring that avenue without really having.
I like the term leveling up. That's,
and it could,
and people argue what's more complicated. I mean, at least from my standpoint, I do think development's more complicated because now you have to design the unit mix, right? When you buy value add, you inherit whatever unit mix, and maybe you can adjust it, a little bit, take 2 1-bedrooms and combine it into 2-bedroom, like that happens, but that's very rare, right? So we have to design a brand new unit. So we have to like the knowledge, what units are appropriate? What is the market demand? What's a buildable unit? Am I going to rent that brand new unit? Maybe nobody wants a 5-bedroom, 4-bath, right? Like it's an experiment, right? As I say internally at the company, it's like, we're in this grand experiment. Now we be cautious, we start small, we build the model, be successful on several small and mid-sized projects, and they go, okay, now we've proven the model, right? So what a couple of things I'll offer. if people go onto my LinkedIn profile and look under the articles I've written, there's an article in there called 6 Ways to Build Your Real Estate Development Career. And although I wrote it for people that were wanting to get into the real estate development business, like as a career choice, right? Like as a working individual, I think it's applicable for people that are in the investment domain, that may be sophisticated investors. They know how to underwrite multifamily. They have investor networks, and they just don't have this development expertise. And a couple of things, in that article that I think are applicable here, one is, joint venture with other companies. Anybody who listens to Michael Blanc's podcast, I mean, he's really all about that. You're a new sponsor, you want to get into the investment space, pair up with another company who has a track record, capital, contacts and lending contacts, right? You bring the deal and you pair up with somebody, and then you go, hey, look, I need to joint venture this with you, and let me learn. So I get to do a deal, I get to make some money, maybe less than I did on my own, but I learn. So JV is a way to do that. If somebody was really ambitious, go to work for a real estate development company for a year or two. And that's probably not enough to learn the business like outright. But that's another way to do it. Hire somebody. We're having people approach us all the time to say, hey, look, I have a deal. I tied it up. I need a resume, I need a track record, I need knowledge, I need contacts. They invite us to JV or even consult. Like we have a team of people who consult to do that kind of stuff. So there's several ways. I think it's just, and I think Anthony, and you probably know this, any sophisticated deal maker's probably already gone through this process sometime in their career, right? Where it made sense to share risk or share capital requirements, or, hey, I got the deal, you got the money, let's work together. Or I'm going to hire the hired gun because they really know this particular domain. I mean, we do this all the time as a company. Oh, we're launching into this new market, or we're going to integrate a new product category for materials in our unit. Who knows best about that? Who's the expert in that space or in that geographic area? And let's go make a deal with them, pay them, JV them, invite them in as an equity, partner. I mean, there's, infinite number of ways to structure, but, it's production of value. Hey, you have this knowledge, I have this value, let me pay you for it. And we trade knowledge for money or knowledge for ownership. And really it's just an orientation to seeking and giving valuable help, right? So first I have to know I need the help, right? I'm going to San Diego, I want to expand there. Who can I find that knows San Diego? I mean, I know San Diego really well, but who knows it better than us? Who knows, the old adage, if you're the smartest person in the room, then you're in the wrong room, right? And I really am active in surrounding us with people who know way better the things that, where we need to expand or make, new moves into. And then, also we need to be a valuable offer of help back to people. Hey, I'm going to find somebody in San Diego, they know a lot. How do I take care of them, pay them, remunerate them, give them equity that they're like, wow, this is great. I want to keep working with Scott or Pacific. Like, this is great, right? They need to be saying that about us also.
No, that's a good point. Definitely, partnerships are the way to go to level up
Yeah,
in
at
in
least to
any.
start. I don't like partnerships generally, but if you're making moves into new domains, and the other way around partnerships is hire somebody, right? They just work
Sure.
for you, or I don't mean employee necessarily, but advisor, consultant, whatever. But you got to pick the right people, of course, who you partner
No,
with, which this already. Any seasoned investor's been through that partnership thing too. That's a challenging environment.
great. Joint venturing is the right term.
Yeah.
Great. So Scott, so as we wind this down, how can people find you? I know you mentioned your LinkedIn already, but is that the
Yeah.
best way to reach you? And
Well, Anthony, let me make your listeners this offer. If they go to our website, www.urbanpacific.com/ebook, what they can do there is go sign up, and that'll put you on our email list for our Saturday e-blast, but we'll send you our How to Thrive and Survive in a Recession ebook, which, you mentioned it in passing earlier, but this is my writing about going through the 2008 recession and the things to do of, how to not only handle the, disruption of a recession, but also how to capture new territory, right? Like, so you got to survive first, then you got to set up to thrive. And I think this, it's a good, good timing for this. And, we all wish we never had to go through economic down cycles, but, anybody who's been through them is much more like robustly set up for the next one than they were on the first one. And so this ebook can help people with that. When you're there on the website, poke around a little bit. We have a killer investor education section, tons of articles, videos, a lot of like knowledge, offers, meaning, hey, you're, like one of them is a blog post about assessing, land and zoning, right? So if you're somebody new to the space, you want to learn about zoning and, what criteria and standards for land acquisition, we're writing articles about that. We have a video series that sort of track the life cycle of one of our apartment development projects through the entirety of the construction phase. So from like day one, moving out on site through every trade, I went through and shot video, probably, well, it's 13, videos. So really 13 chunks at the cycle, but, somebody can watch that series and walk out and understand how a new construction, at least a residential stick frame building, goes in process and order, what to look for. I'm narrating, hey, watch out for this, look for that. Hey, the subs are telling you this, but you need to know this. So a lot of great education there.
Great. Education is key. So definitely would encourage my listeners to go to Scott's website and reach out to him if you have any questions or want to learn more about what Scott is up to. And if you liked what you saw or heard, if you could please give us a rating on iTunes and review. It helps Scott and I get our message out to a greater audience because that's just the way iTunes works and Apple. So we would really appreciate that. And again, I would encourage everybody to reach out to Scott. So again, just want to thank you for coming on our show today. Hope to have you on again within the next 6 months just to kind of catch up and see how everything's going.
Great, Anthony. So great to be here. Super grateful. Thank you.
Thank you, Scott.